It's deja vu all over again. 5 years ago this weekend, the financial meltdown, it hit when investment bank Lehman Brothers went bankrupt as a housing bubble blew up. Now, many blaming that bubble on the Federal Reserve for keeping interest rates artificially too low for too long. But the Fed has been at it again, keeping interest rates artificially low with a stimulus plan that's on steroids. Could that be causing another bubble that's about to blow up? This time, the stock market itself. Sabrina, what do you think?
I do think that we are at risk for a bubble, but part of the problem is that people don't know where to put their money, right? They don't know, should they invest it in real estate? Should they invest it in the stock market? And when you see the stock market close 140 points up like it did on Monday, there's a real tendency to jump in. But I think that there's a sort of false sense of security in terms of the business market today. You see places like Neiman Marcus being bought for $6 billion or Koch Industries buying Molex for $7 billion, and people think everything's okay, and they're not thinking about the fact that Obamacare is going to be implemented in a few months, and this is going to wreak havoc on the economy. Well, so I do think that people should be cautionary.
John Tamny, if we believe that Greenspan caused a bubble by keeping interest rates artificially low, what does Bernanke do? I mean, he is Greenspan on steroids. Greenspan didn't keep interest rates at zero. He wasn't buying up government debt the way Bernanke is.
Well, you know, when you think of quantitative easing, it is a horrifying perversion of money that robs it of its sole purpose.
Let me just define it for audience members that might not know. That essentially means printing up a lot of phony money in order to buy government debt. Go ahead.
It's real money.
Yeah, and so that I don't think could be driving a stock market bubble. If anything, it's restraining it. I mean, we've got to remember that when investors invest in the stock market, they are buying future dollars. Quantitative easing is an explicit devaluation of the dollars. And so the better question to ask is, if the Fed weren't meddling like this and holding our economy back, how much higher would the stock market be? The Fed is the problem, not the driver of any stock market bubble.
But, Emac, the fact is that older folks who are afraid to play the stock market, they don't have anything to do with the money. Because now if you put it in a bank account, you're losing money because inflation.
Yeah, that's right. And boy, you need a microscope to look at those returns, right? Because they're basically so small. But, you know, to John's point, I mean, even if the money that they sock away, it's going to get devalued because the dollar is dropping and it's going to get hurt. And that's like changing the number of ounces in a pound, right, when the dollar gets hurt like that. And the problem is the Fed has been in this permanent state of emergency. It's like this economic hypochondria. They are printing money like Vegas drunks and the government's spending money like Vegas drunks. But I'm not sure the stock market is in a bubble. It's still trading on a PE basis at half of what it was in the dot-com era, David.
Rich, I don't know about that. I mean, I know that a lot of folks don't think the stock market is a bubble, but most of those folks are people making money off of it.
Yeah, I think Emac is right. I think it's roughly fairly valued, maybe slightly overvalued right now. But it's compared to what? You know, the emerging market economies, which were the stars of the international stock markets for years, are really suffering. Their currencies are really dropping fast, and capital is leaving those countries. Interest rates, as you pointed out, are very low. So we have, what do we have left? We have the American stock market. Profits are still high. I'm always wary of September and October. You know, history says these are, outsized volatile months. But I don't think I would either pour new money in, nor would I get out.
But Sabrina, the fact is that, again, getting back to folks who want to save money, if you try to save money, if you're afraid to put it in the stock market, if you're saving it by putting it in the bank, you're losing money right now. The savers are getting killed, the people most vulnerable.
Yeah, and I just think that I'm always a little bit cautious when there's a lot of enthusiasm. I mean, remember Jim Glassman and Kevin Hassett talking about Dow 36,000? Well, we're not quite there yet, but when everyone jumps on the bandwagon, I think it's a time to say, well, maybe let's just see, maybe this is not the thing for me.
Bill, are these artificial low rates pushing people into the stock market?
The Fed has always been playing a game called asset bubble, and the game works like this. You give people the illusion of wealth by repricing their houses higher and making their stocks go up, even though the houses aren't any bigger than they were before, and even though the companies they're investing in aren't any more productive than they were. Now, this bubble works to a modest degree. I think stocks are overpriced, but maybe by 15%.